Welcome to the GFU Forex trading course. A chart pattern is a shape within a price chart that helps to suggest what prices might do next, based on what they have done in the past. The first chart pattern on our list is the head and shoulders formation. This pattern can exist in two forms. Number one, as a simple head and shoulder. These are the single head and shoulders with straight neck. Number two, as a complex head and shoulder. These are the broad, multiple heads and slanting neck. The same strategy is applied to trade both the simple and complex head and shoulders chart patterns. This chart pattern has a similar human pictorial structure. Here's the head, the right shoulder, and the left shoulder. The head and shoulder are confirmed whenever there's a breakout of the neckline of the pattern. The simple ones have an easy-to-detect pictorial structure. It's usually a single head and single shoulders, while the complex ones have multiple heads and shoulders. The complex head and shoulders can be tagged as the monster's variations because they have multiple heads or multiple shoulders. Also, both the simple and complex head and shoulders chart patterns have three variations of necklines, which are the straight neckline, the ascending neckline, and the descending neckline. The bullish version of the head and shoulder chart patterns is called the inverted head and shoulders. This could be an inverted, simple, or complex head and shoulders. While the bearish version of the head and shoulder chart patterns is called the upright head and shoulders. This can be an upright simple or complex head and shoulders. The time frame in which they form also affects the reliability of this chart pattern formation. A chart pattern on the weekly chart is more potent than the chart pattern on the daily chart. Likewise, the chart pattern on the daily chart is more reliable than the chart pattern on the intraday chart. To avoid false or weak chart patterns, focus on the 4-hour time frame and above. Here is an example of a simple inverted straight neckline head and shoulders. As we can see, the neckline of the head and shoulders has a straight line. Let's find more examples of the complex head and shoulders formations on the trading chart. As we can see here, this is an ascending upright head and shoulders chart pattern. And whenever they formed a downtrend slanting neckline, they are called a descending upright head and shoulder chart pattern. This pattern can also appear in an inverted ascending head and shoulders chart pattern, or as an inverted descending head and shoulders chart pattern. How can we trade the head and shoulder chart pattern formations? To professionally approach this chart pattern, traders need to know how to gauge the reliability and risk factors associated before deciding to trade each one of them in the market. Let's discuss how to trade the straight neckline and the possibility of its winning rate. The best zone to apply stop loss whenever planning to trade the head and shoulders chart pattern is at the high of the upright shoulder or the low of the inverted right shoulder. The straight neckline is simple to approach and has a good risk-to-reward ratio in all market conditions. The upright ascending neckline has a low risk to high reward ratio for the reversal of an uptrend market into a downtrend market because the stop loss from the right shoulder is not far from the neckline support breakout zone. While the upright descending neckline usually has a high risk and low reward ratio in an uptrend because the right shoulder is far away from the neckline support breakout point. In a bearish trend, the inverted ascending neckline has a high risk and low reward ratio in a downtrend because the inverted right shoulder is far away from the neckline resistance breakout point. While in a bearish trend, the inverted descending neckline usually has a low risk and high reward ratio because the inverted right shoulder is close to the neckline resistance break point. As we can see, to trade this pattern, Traders need to wait for a price breakout of the straight neckline. Not just a price breakout, but a decisive price breakout accompanied by great volume. In the later study of this trading course, we will delve more into the importance of volume in trading. But for now, just know that great volume is one of the essential factors needed to confirm the breakout of patterns in the market. Once a strong breakout of price occurs out of the neck, the next step is to patiently wait for the retest of validation of the broken neckline as a new support for the bullish price breakout of the inverted head and shoulders chart pattern. Then next, after a bearish retest, traders should pay attention to bullish entry signal bars. Once this bullish signal bar is formed, traders can enter a long position and then place their stop loss at the low of the right shoulder. As we can see in this upright formation here, after the bearish breakout, price retested the broken neckline once again, and it turned into a new resistance for the price. We can see this pattern led to the reversal of this bullish trend into a bearish trend. The best entry zone is at the point of this retest price action signal bar here. Stop loss can be placed at the high of the right shoulder. To decide to take profit level or measurement profit objective level, traders need to measure from the neckline price level all the way to the tip of the head. Traders can then replicate this price movement to decide the take profit target in the direction supporting the pattern technical breakout. Alternatively, traders can trail their profit once they achieve a profit above the 2 risk-reward ratio level in the trade setup. Take note, it's likely a retest of validation may not occur if the pattern breakout supports the existing trend direction in the market. That means, in a downtrend, there's a higher possibility that a retest of the broken support neckline of an upright head and shoulders may not occur because the pattern supports the existing bearish trend. Likewise, in an uptrend, there's a higher possibility that a retest of the broken resistance neckline of an inverted right head and shoulders may not occur because the pattern supports the existing bullish trend. Traders could make an entry at the strong large volume breakout of the neckline in the direction of the existing trend.